All right, so I'm sitting here with my good buddy Matt Webster, TD Bank. Matt, you've been in the mortgage business for almost 30 years now.
Probably 30 years. Yeah.
You and I have been working together for 28 of those 30 years, and I'm grateful for that. And you're a great client for life of Collins Group Realty too. And so, we just really want to dig into. I think about last year, okay, and there were three I's that seemed like people were really focused on. One was on my side of things, inventory.
Right.
It just wasn't enough inventory, right? The other was insurance, and we've got a whole other video that we've talked about that in terms of what happened with insurance last year. But the other main one was interest rates last year, right? And so we go back, like in the cycle, not all the way back to when you and I started working together, but go back into 2022. That year started, not 23, but 22. That year started when people were at like, 3-4% interest rate. And then by the time we got to June, it had doubled, right?
Yep.
And then all of a sudden, we just kept kind of holding on, and we're thinking, well, maybe some people were waiting to see if those rates might come down. I think the big challenge last year in your world was it really didn't settle down, did they?
Right, correct.
And in fact, tell us about sort of, as you think about 23 and we progressed through, what was driving those rates to not settle down and or really to increase? Did they peak? And kind of where are we now at the start of 2024?
Right. Well, the other I you didn't mention was inflation.
Correct.
So that's the big I, at least in terms of interest rates. So if you think about, before we get into where we are now, but where were we? Where have we been? If you go back to the pandemic, the government was spending a lot of stimulus money to kind of boost the economy and keep things going.
Yeah, for sure.
So all that stimulus money led to high inflation.
Okay.
Inflation peaked in the summer of 22 at 9%.
Okay.
Highest inflation in 40 years.
Right. That was 22.
In 22.
Okay.
So we're just going to go back to that stage of the game. High inflation. So the Federal Reserve started this rate hiking campaign to fight the inflation.
Okay.
So at that point, they kept jacking up the rates to bring inflation down. That all kind of peaked in October, just this past October.
Of 23. Okay.
Yes.
Yeah.
This past October at 8% mortgage rates. Highest rates in 25 years.
So and I think we saw it, inflation, the year-end inflation numbers for 23 were much lower than where they were in 22. Is that right? So in other words...
Well, it peaked at 9 in the summer of 22,
right.
And then it started coming down.
Right.
Yeah, it's been coming down ever since.
So as that's come down, though, we still felt a peak in your world. Interest rates got over 8%.
Mortgage rates went up, kept going up, because there was a fear that the inflation was sticky and it wasn't going to go away, and so they kept raising. So the rates kept going up.
And 8%, and we're not there, right? So we're still gonna move forward. But at 8%, it really felt like there was a lot of pain in the market. But if you run across enough people, they're like, 8%? Are you kidding me? I remember back when it was 15% or 18%, and we sold homes and all that kind of stuff. So in the grand scheme of things, that's not a terrible number. But when you compare it back to the beginning of 22, when it was around 3, it's a significant difference.
Yes.
Right. And all along the while that we also see people talking about insurance, and they're talking about cost of ownership and that sort of stuff. So they really come to you for affordability, which is the real issue. So now let's bring that forward into January here, the start of 2024. Roundabout, what are the rates looking like?
The basic 30-year rate right now is 6.875.
Okay, so it starts with a 6.
Starts with a 6.
Okay.
It's come down significantly.
All right.
From the 8.
And while it rose, and also while it's dropped a little bit, did you see programs like, it seemed like in our world, people would be talking about, well, I'm going to pay a point, or even some of the production home developers in the area were offering like a buy down incentive. Right. So it's like, well, what are you talking about? It's like, well, we're actually going to buy down the rate. We're going to prepay interest. And bring that rate down a little bit. And so you probably saw a fair amount of that.
We did,
right?
yes.
Okay, but then what's the other programs? It seems to me like we're talking about like a 30-year fixed, right? Is kind of the program. But what have other people gravitated to try to abate that rate, to try to kind of get the rate as low as they could?
Well, you can do adjustable rate mortgages. Okay. So instead of locking in for 30 years, you can do a 10-year adjustable. It's about 6.25.
Okay.
A 5-year adjustable is probably 5%. I'm sorry, 6%.
Okay.
So you're locked in for 5 years at 6%.
Yeah, everybody paused like, write down Matt's number. Right. 5%, you said it.
So that's another option, is lock something in for a shorter period of time. That gets you into the house, gets you a decent rate, and then maybe you refinance it in a couple of years.
So
when rates come down.
Go back to that, because I think that a while back, way back, like '08, right? It seemed like there was an area where people kind of got into trouble, was they were really getting caught up on adjustable rates, right?
Right.
And it's mainly because, well, frankly, they just weren't prepared to pay it for a long time. They thought they were going to turn the property, but the reality is now, with the way you're seeing trending, let's talk about maybe what's going to shape 24. You really believe that a shorter term rate program might actually be advantageous for someone?
I think that's a good program right now, yes.
Okay.
Because you could lock in a lower rate now, lower than a 30-year fixed. And hopefully by this summer or this fall, maybe rates would come down a lot more, and then you could refinance back into a 30-year. And
so if you did a 5-year adjustable, it's locked for 5 years, and
locked
then
for 5 years.
Then it can adjust.
Then it will adjust annually after that.
Okay.
But for 5 years or 10 years, depending on which program you choose, you're locked up for that amount of time.
And for that time, it's got a different label, but it's going to feel just like a 30-year mortgage, right? I mean, so it's got a different label, but for 5 years, it behaves the same. You're writing the same check, et cetera.
That's right.
All right, so now we move forward, right? This is where the crystal ball thing, because what everybody wants to know, right? It's like, because I kind of feel like during what we saw was during 22 and maybe even some during 23, until people had all sort of swallowed the pill that interest rates weren't going to suddenly drop back down to 3 or 4 or even 5%. Was folks were kind of waiting for the other shoe to drop. Maybe it's going to escalate back. Maybe it's going to come back down. That really hasn't happened. But where are we now? I mean, if you go back to October now, you're talking about 4 months back where we peaked. And it's nicely below that. Are you sensing it, that the universe is aligning, that all the metrics that you look at, all the figures behind the scenes are indicating that we are on kind of a downward trend?
I would think so, yeah. And I'm a half glass full kind of guy.
Right.
I'm always optimistic. Inflation, we said it peaked at 9.
Yeah.
It's been around 3% for a while now. The Fed wants it to get to 2%. Well, if you look at the last 6 months, it's been 2% for the last 6 months.
Right.
But they look at the annual number. The annual number is 3%. So in another 5 or 6 months, it very well could be at 2%.
Right.
That's the number the Fed's looking for.
Yeah. So as it spends more time at that lower number, they start to believe that that's actually the number, right? As opposed to a blip for a quarter or so.
Right.
Okay. So you're thinking maybe summer into fall.
I think by this summer we should be at the 2% inflation number that the Feds are looking for. The Fed's already indicated they'll probably drop rates about 3 times this coming year.
Okay.
Some people think it's going to be 5 or 6 times.
Right.
So we should have a great year in terms of rates coming down, which is great for real estate.
Yeah, 100%. And so in the meantime, tell me a little bit about the lockdown program. You know, somebody comes to you and says, all right, I'm thinking about buying a house. I'm actively shopping right now. And you've got like a rate lock. How early can people lock a rate? Like if all of a sudden this rate kind of fluctuates a little bit, but then there's a moment where it's like, oh, it got really nice for a couple weeks. If somebody wants to grab that, how long can they lock that in?
Well, when someone applies for a mortgage, we can lock the rate for 60 days.
Okay.
During that 60-day period, you get a one-time float down. So you can lock in today. If rates are better in 2 or 3 weeks, we can float you down.
Okay. One time.
Okay.
That's
right.
All right. And is there anything else that you're still sort of seeing where people can take advantage of while they're waiting for maybe that premium rate to come into the new year, or maybe they're just not really ready to wait? Is there anything else that people are trying to do or take advantage of to kind of make sure they're doing the best program they can with you?
I think the adjustable rate is probably the way to go.
Okay.
I think so.
Yeah. So anyway, it sounds like it's going to be a good year. I know you're going to.
I'm very optimistic about the rates, and also the stock market's near an all-time high.
Right. Yeah, there was a good stock market.
I mean, and that's great for real estate too.
Yeah. So all that's looking pretty favorable. You're feeling pretty good about 2024.
Great. Feeling good.
Matt, always appreciate it. You're a great resource for us, and hope this has really been helpful for you guys as you're watching.